Hi, and welcome back again to Option Analytics Hedges and Edges. We'll take a look at our vol capture trade on Farfetch FTCH, where big repeat call buying sets up a vol capture trade with some big time edge. So let's jump in and take a look. First, pulled off here's the option montage from the day before the big call buying started in Farfetch. It was concentrated in the August out of the money calls. You can see implied volatility just around the 110 level, give or take. The stock at 673. This was on July 18th. As we move forward to July 19th, right, we can see a little over 2,100 of these August $8 calls trade versus only 639 open interest. We can see the implied volatility leaps in price by about 6 vol points. So this is the hallmark of aggressive call buying, to say the least. We move forward to the 20th. We can see that some more further out of the money calls trade, almost 2,000 of the $9 calls trade, and another 4,000 of the August 10 calls trade. You can see the open interest right on those August 8 calls that we saw yesterday, right, has increased as 2,100 trade. All of these hung around basically, so this is sticky call buying. They're building a position out here. You can see implied volatility now over 120. Before the big call buyer stepped in, it was under 110. So this alerted us to a potential vol capture trade idea on Farfetch. Then we can move forward to the 21st, where we see big further out of the money call buying taking place, right? Some more of the 10s, some of the 11s, driving implied volatility all the way up to almost 130. So this sets up ideally for our vol capture trade, selling out of the money strangle, selling the 8-11 strangle and the 9-10 strangle that leans bullishly with that call buying, right? Since these puts are closer to being out of the money than the calls. In fact, the puts that we sold were slightly in the money. So we end up, we'll see in a second, setting up a slightly bullish trade to lean bullishly with that call buyer out there. More importantly, capture the fact that implied volatility has moved from under 110 to almost 130. Then we can see what happens to implied volatility on the 22nd, where as volume starts to subside here, implied volatility drops back down. So that's when we take the trade off, right? We're just looking to basically sell inflated implied volatility driven by big orders having to overpay to get the order done. We hedge it, lean slightly in the direction of that big buying. In the case of calls, lean slightly bullishly. In the case of puts, lean slightly bearishly. Once that buying subsides, normally you get a reversion back towards where it was before. This one only took 1 day, so certainly not all of them happen that way, but the average holding period is roughly 4 days. So that's the idea behind the trade. You can see how the implied volatility has reverted back as the open interest remains pretty much fixed here. So jumping in to take a look at from a different perspective, right? Pulled off the strangle and prices from the 19th, 20th, and 21st. So here was basically the day we saw some of that call buying started, right, where we saw the first uptick in implied volatility. You can see that the 11-8 sell strangle, right, selling the $8 puts, $11 calls, priced at about $1.40. The 9-10 sell strangle, selling the $9 puts, $10 calls, priced at a little under $2.19. You can see implied volatility, right? Basically about 115 on average here, somewhere around the 112 on average here. Obviously, by selling the $8 puts at a negative 47 and then selling the $11 calls at an 18, right? You absolutely are leaning bullishly with that call buying out there, right? You're setting up where your 29 deltas net long, the 9, 10, 61, and 27, even more so as those puts were in the money here. As we move forward to the 20th, right, we can see that big increase in volume, right, implied volatility spiking as well. So even though we had a bullish position on, right, where we're selling the strangle, right, the prices remain basically the same, right? That 910 sell strangle, $2.18, that's where it was the day before. The 811 sell strangle, basically just a little over $1.40. So the fact that implied volatility jumped in price, right, outweighed the beneficial move from a underlying standpoint. So you had a bullish trade with the stock up 60 cents where we really didn't realize anything because of that increases in implied volatility. So we're still waiting here. Then we can see on the 21st where that bigger volume, right, causes IV now to explode. I pulled this off actually intraday on the 21st when we were doing our trade, right? And you can see now how with the stock even higher, right, that 910 sell strangle, right, has now jumped up 18 cents from where it was before, right? So we have a bullish trade, right, that should have gone our way, right? By selling it, you'd expect that sell strangle as we approach, right, the 910 level, 9.5 would be ideal. It actually expanded in price. Why? Because we have this huge jump in implied volatility. The same thing with the further out of the money 811 sell strangle, right, which started somewhere just around $1.40, now has exploded, right, to $1.55, even though it is still a bullish trade, right? So the fact that we're able to take advantage of the fact that implied volatility has driven these prices to extremes sets up ideally for this trade. So let's jump in and take a look at the actual trades here. So here's the fills from the 21st and the 22nd. So we sold the 910 sell strangle, selling the $9 puts, $10 calls, got just under $2.35 net on that. Sold the 8 puts and 11 calls, the 811 sell strangle, for a little over $1.50. Then on the 22nd, right, one day later, we're able to realize a nice gain, right? That 910 sell strangle we were able to cover, buy it back at $2.13. So roughly 20 cents or so cheaper, right? Same thing with the 811, basically covering it at 20 cents cheaper. Here's our actual fill prices, right? So this is on the initial, the sell strangle on the day that we initiated the trade, right? Implied volatility was right around 134 where we sold it. So these are the actual trades from time and sales. So basically pulled that off. This is the implied volatility we're able to sell it at. We were 2 deltas net long on the 811 sell strangle, right? How do we get that, right? Selling a 35 negative delta, right, gives us positive 35 deltas. Selling a 33 delta is a negative 33. So net, we're slightly bullish, 2 deltas net long. Do the same kind of math here on the 910 sell strangle, right? And we'd have a 5 delta net exposure. So it's leaning slightly bullishly. It's equivalent for each one of being long 5 shares of stock. You can see the stock price at that time, 857 on the 811 sell strangle, right? And the 910 at 853. Here's the prices we received on that as we talked about here earlier. Then on our exit side, again using time and sales, here's the time we did it at, right? Obviously it matches up succinctly to the times out here. So our exit fills, right, we're able to cover that strangle, right, at $1.34 and able to cover the 910 strangle at 213. The implied volatility, as you can see, has dropped down sharply. But because the stock has dropped, right, stock went from roughly a little over 850 to 836. We had a bullish position, right? You'd expect to lose money, right? If you bought 5 shares of stock, right, which again is, the equivalent here. So for the 910, right, it'd be equivalent to being long 5 shares of stock. If that stock drops in price, right, you'd expect your position to have a loss. Instead, we have a gain, right? Why? because implied volatility dropped so sharply it outweighed the detrimental benefit of the adverse stock move for us. You can also see our delta is starting to get more bullish, right? Which makes sense simply because this trade will become more bullish as the stock drops, right? The put delta will increase more than the call delta. Conversely, if it goes up, it would happen the other way. So taking a look at our risk, we always like to position size accordingly. We like to use a 3 standard deviation. So we have a very high likelihood, right? We want to make sure we blow it out 3 standard deviations, go out about 5 days because our average holding period is just a little bit over 4 days. So basically we stress it out 3 standard deviations, go out 5 days, and make sure our maximum risk is not more than 2% of the account size. In this case, our model portfolio we're modeling at $500,000. So here's the 2 sell strangles. As you can see here, you can see that at the extremes, right, we'd be looking at just under $10,000 loss if we had a 55% move on the stock to the upside while we had the position on, right? So rather extreme. And then if we had almost a 40% drop in the stock price, we'd be looking at about a $7,500 net loss. That assumes implied volatility would remain elevated, all likelihood, because we're selling extremes of implied volatility, right? That implied volatility probably would cushion some of those losses. Regardless, we don't make that assumption. So taking a look at the metrics here, I pulled them off and kind of put them together just so it's easier to look at. So let's take a look at our 9-10 sell strangle, right? So on the 21st, which was the day where we saw that, big explosion, right, in implied volatility out here. So if we can go back to the 21st, this is the day we put our trade on, right? We see implied volatility at the extreme out there, right? So we were able to put the position on, sell it for just under 235. Our implied volatility at that time, 135. That again is done by simply looking at time and sales and taking the average of our put and call implied volatility. So then on the 22nd, when we saw implied volatility revert, right, we were able to take the trade off and capture a 20-cent gain on the trade. So over the course of 2 days, we have the stock drop 19 cents, right? We had a bullish position with the stock dropping expected loss on the trade. Instead, we had a nice gain. Why? Because of this big reversion in implied volatility. So our smooth delta over the course of 2 days is simply the delta at trade inception and when we close it, taking the average of that. So we were about 10 deltas net long over the course of the trade, right? We started at 5, we went to 14. So our expected loss would have been almost 2 cents on the trade. We're long about 10 deltas, we dropped almost 20 cents, right? But instead, we were able to make 20 cents. Why? Because of this big drop again in implied volatility. So we were able to actually capture 22.5 cents of implied volatility. Obviously, you have 1 day time decay. I'm not bringing that in, but the effect for 1 day is minimal. It'd probably be, not even a penny. So we were able to capture a nice 22 cents or 9.63% 1 day held. And the fact that we wait for implied volatility to revert, we don't look for these things to go out worthless, right? The longer you hold something, the more riskier it can become. So once volatility reverts, and we looked for it to revert about 2/3 of the way back to where it was before, looking for a full reversion from where it started, right? It tends to get sticky, and then that makes the holding period longer, which makes the trade riskier. So we're able to capture a nice gain on that of about $561. The 811 sell strangle, the exact same thing here. Our smooth delta, we've been about like being long 6.5 shares of stock. Stock dropped 21 cents in the time frame from when this strangle went on. So you'd expect to lose, a little bit on the trade. Instead, we made 19 cents or change. So our vol capture on this one, again, very similar It's a little less aggressive trade, selling the 811, right? You're further out of the money on both sides, so you have a bigger runway, if you will, for the stock to move. But we were able to capture a very nice 20-cent gain on that, bigger percentage gain, right? Of over 13% is always, the days held just one day. So the combined effect was we were able to make a little bit over $1,000 on a trade that we were bullish on had the stock drop. So the trade from a stock price perspective went against us slightly, but because we're able to capture this huge implied volatility differential, almost 10 full vol points, right? In the upper nines, gave us that huge edge. You can see our edge here, over 13% and over 9%. So taking a look at it, you can see just what happened on that day where we put the trade on, right? So here's the day where we saw that huge explosion in implied volatility. You can see before that we saw that creep up, as we talked about, with implied volatility creeping, explodes higher. We put the trade on. The following day it drops back down basically towards where it was before, right? So we didn't wait again for it to revert back all the way. We simply took it off once we had a decent amount of implied volatility reversion. Taking a look at it from a kind of picture tells 1,000 words perspective, right? Here is the day before and the day of, right? So the previous close where we sold it on the red dotted line, that shows you the implied volatility on FTCH across the 30-day spectrum by delta, right? We are roughly at the 50 delta, the reversion here. So, and then on the following day when we covered, you can see how that IV reverts. So in essence, we are selling up here, covering up here, all the while leaning slightly bullishly, not egregiously so, with that big call buyer. Another way to look at it, right, here again is the covering rate. The previous day, 125.20, 113.70. So in essence, we were able to sell up here the 125, cover at the 113. So here it is on a longer term perspective, right? This is that 30-day implied volatility. You see how implied volatility pumps and then dumps. So we were able to sell at that peak, and then once it came back down, cover the trade and move on. Another perspective on it, right? Here's the 30-day implied volatility, and we were trading 30 days out. You can see again the previous day where we sold the trade, right, in red, and then in the green line is the day that we covered. You can see how implied volatility dropped there. So hopefully provide some nice insight into identifying how big, in this case, big repeat call buying temporarily distorts the implied volatility surface. We're able to jump in, take advantage of the fact that they will drive up the price of these options to extreme. Implied volatility tends to be mean reverting. We put on a trade that is fairly neutral, leans slightly bullishly or bearishly, whether it's a call or put buyer with the trade. Once that implied volatility reverts, we take the trade off and move on. And as always, we want to position size accordingly, right? Give plenty of runway right on this, where we have a 55% or 40% drop, where our risk level is about 2% of the account size. So again, hopefully provide some insight into identifying situations to take advantage of indiscriminate buying, where the buyers will overpay to get the trade done. We identify that, look to jump in, take advantage of that overpayment, capture that vol, all the while leaning slightly in the direction of that buying. So until next time, as always, here's the good trading.